eyes on Capitol Hill, watching as House Republicans expect to pass President Trump's massive tax and policy bill, but not without some dissent from the Dems. And on Wall Street, it's a half day of trading and a shortened trading week as we move into the 4th of July holiday. There's just an hour to go until the closing bell, and we're seeing markets react well to that fresh jobs data we got this morning. Let's take a quick look at the moves today. Now, just a refresher here in case you're catching up, 147,000 jobs were added in June. That's well above estimates, almost 40,000 jobs above estimates, and the unemployment rate ticked down to 4.1%. And even though some economists say underneath the headline numbers, things aren't looking as solid as they may seem, the market is reacting positively here today, even as traders push back the possibility of a rate cut in July, certainly maybe even for the rest of the year as well, as we look at the shifting expectations. But the Dow is rising here, up 352 points today, getting closer to its record close. Of course, the S&P 500, any gain from yesterday would be another record close, and so we're seeing a gain of about 0.9% as it climbs closer to 6,300. The Nasdaq Composite up 1.1% today. It is also trading at on track for a record close. Elsewhere here today, I want to check on what we're seeing in the bond market because, as I mentioned, the expectations are shifting around the Fed. That means bond yields are higher. We're seeing bigger moves at the shorter end of the curve, and then seeing about a 3 basis point increase there. We also continue to watch the U.S. dollar, although the dollar had been sliding. Right now, the euro is lower versus the U.S. dollar. And interesting, as we see a bit of risk on today, gold prices are falling. Elsewhere, just a quick mention of some other things that we are watching. Here's the Dow Jones Industrials today. JP Morgan once again trading at a record in today's session. Add it to the list of all the many records that we are watching. And then there is the market cap race. We're going to talk more about this a little bit later in the show, but you see that the Magnificent Seven are trading higher today. And look at the market cap here. So Microsoft trading at a cool $3.7 trillion valuation, but bigger than that, NVIDIA shares are at a record again today, and we're closing in on $3.9 trillion, getting ever closer to that $4 trillion market cap. So we're going to keep watching that. And we'll talk about it with Dan Ives, who has also been on 4 Trillion Watch later in the show. Let's bring in our team coverage here. David Miller is co-founder and chief investment officer and senior portfolio manager at Catalyst Funds. Our Washington correspondent Ben Werschkel is with us, and our Federal Reserve correspondent Jennifer Schonberger, all joining us live to break down the latest. We're going to start with Ben here to get us started on where Trump's big, beautiful bill stands right now. We are still waiting for that final vote, right?
Yeah, so we are 6 hours at this point into speak from House Minority Leader Hakeem Jeffries' speech. This is in House parlance is a magic minute, but he can talk for as long as he wants. It's clearly an endurance test at this point, so he will have to yield the floor at some point. And at that point, as you mentioned at the top, the President Trump is expected to get his big, beautiful bill passed. The big breakthrough here came overnight at about 3 a.m. when a key procedural vote only saw one Republican defection on it after there was multiple dozens who were wary of the bill just as recently as yesterday. That's a very good sign for House Speaker Mike Johnson and the final vote, which we are expecting in the coming hours. The phase we're in now, I will add, is I think we have kind of moved past the sort of whether or not this is going to pass phase, and we're into the court of public opinion about this bill. This is what this speech from Jeffries is about kind of making the case to the larger public as to why, from his perspective, this is a bad bill. President Trump is going to be in Iowa later today, so I think we're going to hear a lot more from his side. And this kind of gets to the larger question about this bill as we head sort of towards its enactment and the coming elections, which is that the American public both doesn't know a lot about this bill, and when they are asked and they're presented with certain things, especially healthcare cuts, they're very mixed. So this is going to be something we're going to be talking about not just today, but for a long time.
Yeah, and Ben, I mean, I guess the operative word in the bill title is big. To your point, that it's difficult to get through all of the parts of it. And I talked to Kevin Brady, former House Ways and Means chair, earlier today about this. The Dems certainly are painting this bill as much more favorable to the wealthiest Americans and unfavorable to the poorest Americans on an objective basis. Knowing what you know about the bill and as complex as it is, how do we suss out what's actually true?
Yeah, so economists have done work on this. The Yale Budget Lab has done some of the best work on this, where they break it down by quintiles. And it is objectively true that when you add up all these different provisions, cuts to healthcare, cuts to food assistance, things like that, paired with tax cuts, it is more negative for those on the lower end of the income spectrum. If you're on the lower end of the income spectrum, you may not have tax on tips. That could be a benefit, but you're going to have a drag if you lose your healthcare and things like that. So if you're in the bottom 20%, the projections are you are going to lose, you're going to be net off worse from this. Whether that all comes to pass, as you mentioned, this is big and complex, remains to be seen. But it's clearly the projections at the moment are that if you're on the wealthy side, this is a help. If you're on the bottom side, this is a much more mixed bag.
And David, let's get the sort of market perspective on the bill, right? It seems like investors have been waiting for this. They've been waiting for it anxiously and optimistically. And is that sort of how things are playing out in the end?
Yeah, well, I mean, it looks like they have the votes now. There were some holdouts in the House that seem like there's enough now that the bill will pass. And it's a really clear shift in the administration's priorities, which you can clearly see with how upset Elon Musk has been about it. I don't think the key question is this better for wealthy people or poor people? The real issue here is this was a complete switch in priorities. Before, the priority was they were going to go with the Doge path. How do we run a balanced budget? Now, the big is also, it's not just how big the bill is, but it's how much money they're spending. What are we doing about deficits? Clearly, the plan now is stimulative government spending, keep the economy growing, and the administration is not happy with what happened earlier in the year. When you look at the impact of tariffs combined with Doge and austerity, now they're willing to spend money to make the economy do well. The bigger question isn't, does this hurt somebody short term? It doesn't hurt anyone short term. The big question is, can the country afford this long term?
And what would be your answer to that question?
Well, the easy, obvious answer is no. You can't have a $36 trillion debt and keep spending $1.8 trillion in deficit spending. It's effectively a tax hike, but it's not a direct tax hike, even though it's, in a literal sense, a tax cut. It's a tax hike via inflation, which has to kind of continue by default when you keep expanding the deficit and the debt.
Well, and of course, servicing the debt has been a big issue. We've heard the president complaining about the cost, the interest that the government is paying on that debt. And that brings me to Jen, because we saw the jobs data today, of course, the labor market adding those 140,000 jobs in June. So then that brings us back to the Fed, where that leaves them, and how that all feeds through into the political realm as well.
Yeah, Julie, I mean, that stronger than expected jobs report clearly taking any chance of a rate cut at the Fed's next meeting later this month off the table. And Wall Street seems to agree with that, right? Take a look at those Fed funds futures. Traders now pricing in a 95% chance that the Fed holds rates steady at their next policy meeting on July 30th. And reinforcing that, just last hour, we heard from Atlanta Fed President Raphael Bostic, who says he fully supports the Fed's wait-and-see policy prescription, saying that, quote, "I believe the committee must await more clarity rather than move in a policy direction that it might need to quickly reverse." And Bostic says, as it comes to the job market, that it remains broadly healthy right now. While hiring has slowed, he's not seeing any major layoffs, and the unemployment rate remains low. He also noted that he doesn't see any, quote, serious deterioration right now in the job market. It's the inflation side of the Fed's dual mandate that Bostic is focused on and more concerned about, similar to Fed Chair Jay Powell. For Bostic, he doesn't think that it's going to be a one-time increase in prices as it relates to the impact of tariffs on inflation. He thinks we could see a more prolonged scenario where we could see inflation remain elevated, but he doesn't expect to see price hikes, or spikes, I should say, per se. So it definitely seems that the Fed is going to hold rates steady at the next policy meeting, barring any sort of surprises. It is going to be interesting, though, to see whether Fed Governors Mickey Bowman and Chris Waller opt to go ahead and vote for cutting rates at the next meeting, because both of them have said that they could see cutting rates as soon as the July meeting. And Mickey Bowman in particular says she's more concerned about the employment side of the dual mandate rather than inflation.
What's fascinating to me about all of this, David, is that the market doesn't seem to care if the Fed is cutting rates? In other words, at one time, you would have gotten this jobs data, you would have seen the odds fall for a July cut, maybe even a September cut, and stocks would have gone down. The sort of good news, economic news is bad news for the market. That didn't happen today. What does that say about investor psychology right now?
Well, I think this tells you that what investors are more focused on right now is what's happening with top-line GDP growth, what's happening with companies' EPS growth, rather than the denominator side of the equation on interest rates. I think regardless, this bill, regardless of what's happening on the front end of the curve, it's got to push up rates on the back end of the curve. And I think that's kind of the way that investors are looking at it, is they're focusing more on the impact to earnings than they are the impact to rates.
All right, Jen, Ben, thank you. David's going to stick around. And as we've been discussing, employers continued hiring at a steady pace in June, casting aside concerns about the economy and notching another month of relatively solid job creation. The Labor Department released its monthly snapshot of the jobs market. Payrolls up by 140,000, the unemployment rate falling to 4.1%. Lorena Urucci is chief U.S. economist at T. Rowe Price. She's joining us now to help put some perspective on the numbers. But Lorena, so what's your take on all of this that we have been discussing? Because I've heard some sort of differing takes on the market, on the jobs data today, that it doesn't necessarily say things are amazing or super solid in the job market. How are you reading these numbers?
Hi, and it's great to be back. I would say there is a lot to unpack in this jobs report. It's true that the headline number surprised to the upside, and overall employment growth was fairly solid in June, but about half of that was driven by the government sector, state and local in particular. I don't think we're going to continue to see that in the coming months, especially given what's going on with the hiring freezes at the federal level and the restrictions on state and local transfer from the federal budget. And so then when you strip that government boost to overall employment growth in June, I would say that the numbers are looking a little bit less resilient. We see a real deceleration in private sector and services sector growth here. So that's one element that is not as positive as the headline number would suggest. Another one is that you look at the decline in the unemployment rate and you might think, oh my God, payroll growth is increasing a lot and we're having a tighter labor market. But in fact, what is happening here is part of that is driven by the fact that the labor supply is declining. Whenever we have that, the unemployment rate tends to trend lower. And we have a lower labor supply because of aging population and because of slower migrant flows into the economy. Those are generally not that positive for aggregate demand. And then finally, you look at wage growth, and that's continued to slow steadily in the last few quarters. And so this is an indication that the labor market is not a big source of inflation. If you had a tight labor market like we did in 22 and 23, wage inflations would be accelerating, not decelerating. So a lot to unpack here. I think where it leaves the Fed is that there is no clear bad news here to suggest that they need to urgently cut in July. So it's going to be difficult for those dissenters to justify a rate cut in July based on the payroll report alone. But there is nothing here to make them overly hawkish either. So they need to see and watch the progress on inflation in the coming months.
And Lorena, the Fed always has a tricky time because of the sort of long and variable lags, right? Both when it is cutting and as it's raising rates. And so in this case, if indeed there are some signs under the surface that labor market conditions are deteriorating, is there a risk of waiting too long and then those rate cuts taking, further deterioration happening while we're waiting for those rate cuts to potentially help?
That's exactly the risk that the Fed needs to balance this year. Is it keeping monetary policy restrictive for longer than necessary? When you look at the interest rate adjusted for inflation, the real rate is quite high by historical standards. So if the Fed was basing monetary policy based on backward-looking data alone, we've had some good inflation prints. We've had this easing in labor market condition, even if it's not weak. And so maybe policy doesn't need to be as restrictive as it is right now, but they have to make policy forward-looking based on the outlook for the economy. When you look at that, the risks to inflation are all moving to the upside. You have the tariff effect, which may or may not be a one-off effect. I think in the last round of tariffs, they didn't leave a lasting imprint on inflation, but then inflation expectations were more anchored, and then we were looking at inflation from below target, not from above. So I think that's that to consider. There's also the fact that I think going forward, we've had a weaker dollar and some energy volatility, and they all push the outlook for inflation higher, as well as the one big beautiful bill that will likely get passed in Congress today.
Let's ask about the one big beautiful bill then from an economist's perspective here. How stimulative do you think that will be? And I guess I should couch this by saying, it's pretty much status quo in terms of the bulk of the tax cuts, right? The extension of the tax cuts in this bill. So I wonder, on top of that, kind of how stimulative it will be.
So in this program, you have already covered the dynamics about the distribution across the income spectrum. I want to talk a little bit about the distribution across time horizons, because I see elements in the bill that could stimulate the economy in the next, let's say, 2 to 6 quarters. But then all the pain comes after the 2-year horizon. So I think we have a mismatch here. And perhaps this was intentional. Give the economy and the private sector this boost and this help in the near term to sterilize the effect of tariffs, the effect of higher inflation on growth and demand. But then further down the line, that's when the pain comes. But here we're looking at markets, we're looking at shorter investment horizons. For that purpose, I would say that the risks to growth are to the upside for 2026 from the fiscal package. And we've learned our lessons since the pandemic. When we have a combination of supply chain disruptions, which is what tariffs may cause, and when we have fiscal stimulus coming at the same time, the combination of the two can have a powerful upside effect on inflation. Now, the shocks right now are not as big as they were back in 2022, but I think the direction of travel should be the same.
Lorena, great to see you. Thanks so much for joining us.
Thanks for having me.
We're just getting started here on Market Domination. Coming up, Wedbush's Dan Ives will join the show to give us his expectations for the second half of the year. There he is. He's ready to go. He's going to give us his top 5 tech stocks to watch as well. Plus, at 12:30, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deeper dive into 2 tech stocks to help you make the right moves for your portfolio. Stick around. More Market Domination still to come. It was a mixed bag of emotions for tech investors in the first half of the year, but still the sector is up 10% year to date if you look at the XLK. Dan Ives, Wedbush Securities Managing Director and Global Head of Technology Research, is with me now. Dan, you're never a mixed bag of emotions. You are usually a very positive guy when it comes to the sector you cover. And no surprise, you think that we are going to continue to gain here. What do you think is going to be the catalyst for a continued rally in some of these large cap tech stocks?
Yeah, and look, to me, Julie, it's the next step of the AI revolution. Because when you think about what's happening now on software, on consumer, on autonomous, physical AI, robotics, we're just in the beginning. I mean, you're really just in, call it what, 2-3% through what's going to be really what I believe not just a bull market, but this cycle of spending is going to go on for the next 8-10 years.
And what is that going to look like? I think we're all still kind of trying to figure that out, Dan. I mean, you're really steeped in these companies, so it seems like, it's making some progress on the enterprise side, if not as much on the consumer side, maybe. But what does it look like to you?
And look, I'd say on the enterprise, also remember only 5% of enterprises have even gone down this path. And that's only in the US, none in Europe, none in Asia, ex-China. So just think about how early days we are, and that sovereigns is just starting to play out. I think on the enterprise, that's a year and a half ahead of the consumer. But really, if you look at Meta, to everything we see, what's going to be on the advertising side, to the hundreds of apps that are going to be built in terms of AI, to robotics, to autonomous. The consumer, when it comes to ChatGPT and Perplexity and the models, that's just the beginning. That's almost like a baby relative to what we're going to actually see when it comes to AI. And that's why we believe, we're going to be talking about NASDAQ 22,000, 25,000, 30,000 over the coming years.
Dan, you are now in the ETF game. You've lent your last name to an ETF that includes many of these picks. And I can't help but think of sort of the mother of disruptive tech ETFs, Cathie Wood, and her ARC Innovation ETF, which has done very well this year, but as you know, has had a lot of ups and downs because these disruptive tech names, they don't always do great versus the market, right?
Sure.
And sometimes these disruptive technologies don't work out or don't work out on the timeline that you think they're going to work out on. So when you're sort of applying your criteria to these stocks and trying to figure out what's going to outperform, how do you think through that and some of the risks and some of the timing and cadence of all of this?
It's a great question. Look, and it speaks to the Ives AI 30 report that the ETF's all built on in terms of Ives. Look, if I focused on what a stock's going to do over the next month, 2 months, in terms of gyrations, geopolitical, maybe even earnings, right, where they could be soft in terms of conservative on guidance, you never would even go into this. My point is we are in a fourth industrial revolution. And I believe it's the biggest technology theme we've seen in the last 40, 50 years. I'm focused on companies, not just, of course, godfather of AI, Jensen, NVIDIA, Palantir, Microsoft, and a lot of the bigger names, but who are the second, third, fourth derivatives of AI in software, in consumer, in cybersecurity? And that's the vehicle. It's a way to play the theme that's going to be trillions spent over the coming years.
Dan, I want to get you to pause for just a second because I have David Miller of Catalyst Funds here with me on set, and I'm curious to get his take as well. David, as you hear Dan talking about this sort of fourth industrial revolution and trying to figure out who the winners could be in AI, as you're applying your investment criteria, how do you think through some of these themes and how heavily do you think investors should be sort of indexed to some of these players?
Yeah, so I guess I fully agree with his thesis. We just have a slightly different angle on it. So we have this ETF that we recently launched. It's called the Monopoly ETF, ticker MPLY. And the idea is we're not necessarily trying to identify who's going to be the next big winner. We're trying to identify who is already the big winner that's going to continue winning, that has extraordinary dominance, extraordinary margins, great free cash flows. And I think that's a much easier game to play. And when you look at it with AI in particular, it's easy to see that NVIDIA is a big winner. And many of the hyperscalers have been spending an incredible amount of money that's going to NVIDIA. But then if you look at a company like a ServiceNow or a Meta, you can see that their earnings have been absolutely exploding with AI. People were very concerned about Meta years ago when Apple refused to share data with them. That's completely irrelevant now. The data that Meta is getting now from AI that gives them the ability to optimize their ads is infinitely more valuable for getting higher CPMs on their advertising than what they were getting from Apple years ago. If you look at a ServiceNow and their ability to automate customer service and make things more efficient, you can think about it as a lot more spending on AI over the next several years. But I think the much bigger way to think about it is how much additional productivity do we get when we have all the world's knowledge at our fingertips and we can use the compute to actually solve those problems using that knowledge. And I think people generally have a kind of difficult time thinking exponentially as to what that can really mean. And certainly that happened with the internet, but I think you can certainly see that happening again, but probably even bigger with AI. It's hard to imagine that we won't be using tech more 5-10 years from now than we are today.
Yeah, Dan, I think same page. I'm sensing probably from you guys. I mean, I know you like in terms of your picks for the second half of the year, Dan, you're looking at NVIDIA, you're looking at Meta, which you mentioned already, you're looking at Microsoft, which is trading at a record again, you're looking at Palantir, ditto, and you're looking at Tesla is the other one. Tesla, I feel like, is like one of these things is not like the other, certainly in terms of the stock performance at least, but Just briefly here, for the second half of the year, why are you focusing on those 5?
Because, I mean, ultimately, it's each phase of what I think is starting to play out. Of course, NVIDIA, not just 4 trillion, I think it's the path to 5 trillion market cap. And then you look at on the hyperscaler side in terms of Microsoft, Meta leading on the consumer, Palantir, I think that's $1 trillion market cap in the next 2 to 3 years. And Tesla, I've used the best AI play along with NVIDIA because autonomous worth $1 trillion of the story. And it all comes down to those that focus on valuation. You know, they've missed every transformational tech stock the last 20 years. And I always say, like, the bears, when they're in hibernation mode in their caves, they can't find AI in the spreadsheet.
I mean, David, I would ask as well, though, on the flip side, or I guess I'll put this to both of you. David, I'll put this to you first. Given how heavily weighted these companies are in the S&P 500, why should investors just buy the S&P 500? They still can participate in a lot of the upside from these stocks because they are so heavily weighted, but they also get maybe the cushion of some of the other stuff. David, how do you think about that?
So I guess the way I would think about that is, first off, I agree you're generally right. You're probably going to do very well if you own the S&P 500. And if you don't own these names individually, that's not the end of the world. But do you really need to own the large airlines, which have never made money over decades on net? Do you need to own the large automakers that aren't Tesla, that are incredibly difficult businesses with enormous pension liabilities? I think conceptually you do want to own a lot of those names that are in the S&P 500 that are showing great free cash flow growth, great dominance within their industries, great products that are making people's lives better. But you don't have to really own some of those companies in the S&P that are in much more competitive industries.
And Dan, what about you?
I mean, I think David, it's a great way to put it. I put it another way. I mean, I just say I want to own the Ferraris in the left lane going 100 miles an hour. I get every once in a while you'll get a speeding ticket, but I don't want to own the minivans in the right lane going to 45 miles an hour with a broken radio. I'd rather be in the left lane owning those. And those, to me, that's where you stick in big tech, and that's why I think it's get the popcorn out. It's going to be a very exciting second half.
Dan Ives, the king of analogies, the king of fancy sport coats. Thank you so much for being here, my friend. Have a great holiday.
See you too.
And David's going to stick with us. And coming up, it's the latest edition of our series, Goodbye or Goodbye. David's going to help us take a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come. Welcome to Goodbye or Goodbye. Our goal is to help cut through the market noise to navigate the best moves for your portfolio. I'm here with Catalyst Funds co-founder, chief investment officer, and senior portfolio manager, David Miller. So let's get right to what you like, David, and that is Robinhood. So this is one that's already done very well over the past year. I think it's up some 300%, and it's more than doubled this year alone. So let's talk about why you still like it, even with that. So one of the things that you watch in your portfolios is insider buying. And so we've seen some insider buying here for Robinhood, right?
Yeah, absolutely. Christopher Payne, a director at Robinhood, he fairly recently bought $1.9 million in stock in Robinhood. And when a director already has significant holdings in the company and they have some compensation tied to that company and they want to take more money out of their own pocket to buy more, that's always a good sign.
Yeah, let's talk about some of the other catalysts here. Robinhood, a number of products that this company's introduced over the past year has been pretty incredible. You're focusing in on tokenized stocks in particular. And this is basically I guess it's self-explanatory. It's a stock, but you can buy a token tied to that stock. Why is that an attractive thing for investors?
It really makes it so that Robinhood, rather than being a typical brokerage, is more the exchange themselves and fully dominating that market. Now, this isn't particular to the US yet, but this is a really interesting innovation that they have going on in Europe and where they recently launched in the UK and also in Spain. And then they're likely to be doing that in the near term in Germany. And Germany doesn't have free stock trading at the moment. So they're really coming in a position where they have some clear competitive advantages.
Why would you want to buy a token of a stock versus a stock?
Well, then you can trade in fractions, you can trade how you want. It's very open to the retail market. And frankly, it makes it more like a video game. They've really figured out how to
That's
turn
just what we need,
stocks
David.
into entertainment. Whether or not people need it, they like it.
Yeah, they do like it. It's worked for Robinhood. And then there's the consistent growth. As it's come out with these new products, as it's gained new users, the company has grown.
Absolutely. I mean, they grew 60% on revenue last year. They did over $300 million in earnings on over $900 million in revenue last quarter. They're developing in a huge way because they've been able to offer 3% on credit cards that competitors can't because they don't get the brokerage business on the side through cross-selling. It's just been a tremendous growth story.
All right, let's talk about what could be an obstacle. And it's coming back to the beginning, it's the valuation after we have seen that stock just scream higher over the past year, but it hasn't really stopped it, right?
Yeah, frankly, likely the valuation is fair or might even be cheap at probably about 35, 40 times forward if they can keep growing in the way that they are. Now, consumers love Robinhood and they'll probably continue to love Robinhood. The real question is what happens when we hit a bear market? And that's where the valuation may not be justified because this isn't something like AI where it'll just keep growing through a bear market. People aren't going to be so thrilled when they're messing around with tokenized stock and it's going down.
And also just a quick follow question here. There has been some speculation that Robinhood might enter the S&P 500. The latest round of announcements for inclusion did not include Robinhood, and the stock is down a little bit on that. Is that something that you think is necessary for the stock to continue to go higher, to be included in the S&P?
Regardless if the company keeps growing revenue, keeps growing earnings, they keep launching new products that consumers love, they will eventually be in the S&P 500. It's more just a question of when, not if.
Okay, let's get to the stock that you do not like as much, and also in the fintech realm. That's Mara Holdings. It's a Bitcoin miner, and that stock is down some 15-16% over the past year. So let's talk about why you don't like this one. It is not cheap to mine Bitcoin, but this company pays more than its peers or has higher costs. Well, what's going on there?
So the issue with Bitcoin mining is it's frankly a kind of crummy competitive business where no one has some specific competitive edge unless you get free power. If you have free power and you're tapping into a dam in China or you're in Iceland and you have tremendous geothermal power, you can have a unique competitive advantage. The big problem with Bitcoin mining is the higher the price of Bitcoin goes, the more it costs to mine Bitcoin, the more compute that has to go in to each transaction. And that's actually a pretty big net negative. And frankly, if Mara's not doing better while Bitcoin's over 100,000, you can only imagine if Bitcoin fell in terms of prices, what could happen to their operating leverage.
And it's trading at a premium to its Bitcoin holdings. Now, this is not necessarily unusual. If you look at Strategy, whose whole strategy is being a Bitcoin treasury company, it also trades at a premium. Why is that a problem for Mara?
They've really figured out a bit of a weird infinite money loop until it breaks over at Strategy or MicroStrategy, largely because they have this ability to keep issuing more convertible notes without having interest payments tied to those directly. Mara doesn't have the ability to do that because they frankly lost a lot of money historically Bitcoin mining, so people prefer being in MicroStrategy from that perspective. It's not that I'm necessarily negative on Mara if Bitcoin prices go way higher. It's just you'd be much better off owning Bitcoin itself or owning Strategy.
Gotcha. And we kind of touched on this, but you say no unique competitive edge. It's not in Iceland, for example.
Sure. There really is none. You can think about it like any other mining business. There's never been this mining business that's been a tremendous business because anybody can do it. There's no ability to be better. It's a similar concept to if you own a bus company or an airline. You can't do anything that's unique or better that creates real customer loyalty and higher margins.
And then let's talk about what could go right for Mara in your view. They could get out of Bitcoin mining entirely and maybe just do Bitcoin treasury, or maybe lease some of their space to hyperscalers, for example?
Yeah, I mean, frankly, I think the thing that could go right in the biggest way is if they dump all the Bitcoin mining, take the money they're allocating that, buy more Bitcoin, tell the market they're doing the same type of thing that MicroStrategy is doing, and Bitcoin prices go up. That'd be the main scenario where it could do well.
Gotcha. Well, they're not doing it right now.
Not yet.
This is where we have. And you do not own Mara in any of your strategies. You do own Robinhood through some of your portfolios, correct?
That's right, yep.
All right, David, thank you so much. And thank you so much for watching Goodbye or Goodbye. We'll be right back. President Trump's tax bill is making its way through Congress, and its passage could reshape the energy landscape in the U.S. For more, we're bringing in Sean Severson, head of energy transition and sustainable investing research at Water Tower Research. Now, Sean, it's been tough to keep track of the different versions of this bill, right? There was a tax that was actually added at one point for some of these companies. Then that was taken out, but there's still the phase out of credits for the renewable energy industries. So, this final version, what is the sort of big takeaway for this business?
Well, great. Thanks for having me, Julie. And again, I think breaking news we just had, right? It's just going through the process. But I think there are a couple key takeaways for investors to consider. First and foremost is that some of the big key megatrends will remain in place on the other side of this. And that I'm referring to things like distributed energy generation, for example, and increased demand for electricity. So fundamentally, the demand for power is in very good shape over the long term. I think we're just seeing a mix shift here in how some of this is going to impact some of the clean energy and energy transition companies. It's not good for any of them, but there's certainly some differences between those that, I hate to say have and have nots, but certainly those that won't be as negatively impacted. We can run through some of those sectors as well, but clearly impacting the entire industry.
Well, I'm curious, given what you're saying and what seems to be taken as a given here, that there is enormous demand for electricity, some of that because of population, some of that because of data center demand, right? Why do these types of companies still need the tax breaks, for example? Let's take solar as one example, right? Which seems to be sort of almost a bridge energy source at this point between some of the coal of the past going to things like maybe more nuclear in the future. Why isn't there enough demand to fuel solar without the tax credits?
Well, I think it goes back to the long-term competitiveness of things like natural gas and large-scale turbines, and can solar compete on an equal basis, let's say. I think though what's happening is it's forcing the entire industry to start to look at economics and fundamentals that can compete on their own. I mean, I've been covering energy transition and clean tech for over 15 years, and you always heard investors say they didn't like the idea that it had to be subsidized or that it was dependent on government regulation. So I think as we're going through this, especially more mature industries like solar are going to be able to compete over the long term and effectively. And then there are some other areas as well that we think will still continue to compete effectively, but it really changes the mix over the short term and who's going to be able to be there. But in the long term, all of these technologies will have to compete more or less on an equal basis with fossil fuels, and that'll create stronger companies and longer survivors, in my opinion.
I'm curious though, will it be competing on an equal basis with fossil fuels, or will fossil fuels just get the subsidies that these guys were getting, right? So that's not equal either.
That's a great point, and it's certainly a sensitive subject amongst companies and advocates for renewable energy. What kinds of subsidies or easy access, like permitting and leasing and things for conventional energy. But you have to look at a couple bigger trends that are in place too, and that is going back to distributed energy generation and decentralized power, where renewables, particularly when paired with batteries, for example, and energy storage, can be very competitive on a local basis, along with small-scale nuclear as well. But the idea of building large coal power plants, I don't think that's going to be coming back. It's more or less what technologies are used on distributed energy generation closer to the use cases.
So, Sean, for investors, right, you said that in the long term, there's probably a place for all of these energy sources. In the short to medium term, what kind of subsectors do you think are best poised to outperform for investors?
We certainly think nuclear is, and there's debates whether that's clean energy, but it is through consideration. I think if you look at that as being able to provide large baseload power, that is key. We think some of the small modular there are companies out there like a NewScale and some of the others in Oklo that are out there are interesting in terms of the technology solutions they provide. I think some of the others that are maybe overlooked by investors today is the renewable fuel sector. And I know that's been a long topic and a touchy one for many investors. But over the longer term and even over the short term, you have to remember much of our supply of renewable fuels comes from domestic agriculture. It truly fits into an America First philosophy and policy. And some of the benefits, coming from the big beautiful bill extend some of the credits that are important to the industry. So I think that's one that could be overlooked by investors over the short term and probably should be looked at closely as a sector that could thrive in this new environment.
And on the flip side, if you look at some of these individual solar stocks, hydrogen stocks, some of them are trading like they're going out of business in some cases or are in danger of doing so. Do you think there will be casualties from this credit phase out?
I think it requires good business models. And one of the things that investors have always focused on, but are certainly focused.
Oh, it looks like we have lost Sean there talking about the what's going to happen from the bill here. I think we've got Sean back. Sean,
did you get me back?
Yes,
Yep,
we got you back. You want to finish your thought there on
Apologies.
some of these companies?
Yeah, the business model itself has to be supportive. So you can't be green for the sake of green. You have to be green for the sake of an ROI. So I think some of the stronger solar companies, those that particularly have domestic supply chains, good cost of capital, they can be competitive. So they're not all going to go out of business. But remember, this is based on ROIs that have been assisted or lifted by renewable energy credits and requirements. So the whole industry has to take a step down. You have to look at what the ROIs are out there for these companies and for the investors. And the strong will get stronger in this case, but it will sort out weak players. There's no room in this, as ROIs compress.
Sean, great to catch up with you on this as we await the passage of that bill. Thank you.
Thank you.
Time now for what to watch. The markets are closed on Friday for the July 4th holiday. Starting off on the earnings front, looking ahead to next week, we'll be getting some reports on Thursday from Delta Airlines, Conagra, and Levi Strauss. Delta will announce results for the second quarter in the morning. Profit under pressure for the airline in Q2. Analysts expect domestic travel demand will weaken due to economic uncertainty, with planes flying at less capacity than last year. Moving over to the Federal Reserve, we'll get some commentary from Fed presidents on Thursday as well. This comes after recent comments from Fed Chair Jay Powell. He says he's not taking an interest rate cut off the table in July. He agreed that the central bank would have cut rates by now if not for tariffs. Taking a look at the economy, the NFIB Small Business Optimism Index comes out on Tuesday. Economists forecast that number will drop to 97.9 in June, signaling that small business owners in the U.S. are feeling less confident about the economy. While we're wrapping up today's market domination, don't go anywhere. We got you covered with all the action following the closing bell. Yes, it is a holiday shortened trading day and week. We got you covered with market domination overtime.